Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me this afternoon, we have Alex Coffey, Senior Market Strategist at Charles Schwab, as well as Chris Dearborn, Managing Director on the Nasdaq Market Intelligence Desk. We're here to discuss if the market is already priced in rate cuts as investors look to the FOMC minutes and Jackson Hole symposium to provide insight into Fed policy and outlook. Guys, it's great to have you as always. Welcome back to Trade Talks. And Alex, really, this is what the month of August has been predicated on, what the market has been waiting for, in addition to some key earnings we can expect next week.
No doubt about it, Jill. Thanks as always for having me. But I always describe the market as kind of a pendulum, one that swings and it gets overextended in both directions. We had a market in the early parts of July that was questioning whether or not we'd get a rate cut in September. And we swung to, we needed 75 basis points yesterday at the very beginning of August. We've watched the market normalize over the last few weeks, but it kind of got caught between, are we going to get 50 basis points? Or are we going to get 25? I think what we've heard so far from the FOMC minutes, what we've heard so far from the data the last few weeks, and what we've heard from the beginning parts of Jackson Hole is that it's leaning towards 25. And we're starting to see a little bit of a downwards pressure on treasuries. And we're seeing a little bit of a downwards pressure on the equity markets today. But some of this is, also just a quiet market that was maybe a little bit overextended after, 9 out of the last 10 sessions seemingly have been to the upside. That's not necessarily a trajectory that can continue forever. So some of this is, let's not get caught up in the noise. Let's get through Jerome Powell. We'll have a better idea in 24 hours.
Yeah, and Chris, really what the challenge has been for traders, and we spoke about this with Steve Sosnick the other day, is it's the pain trade, right? You have one day for a massive direction change, and then all of a sudden you're back onto another trend, whether it's to the up or downside. Lately it's been to the upside, but it really is, it's interesting to see how these are playing out when some of these trends could have taken a few weeks, a few months to play out, and they're happening within intraday sessions.
Right, so market sells are generally very quick and violent when you come on a knee-jerk reaction like they did to the non-farm payroll numbers. And then rallies are very much slow, boring, and generally lighter in volume. Baby steps on the way up. That's why the trader adage is never short a dull market. When you look at the way the market moved at the end of July to the beginning of March, and that Friday into Monday when we saw the sharp sell-off, we're down over 7%, it was on fears. And fears kind of escalate one on top of the other. Nobody wants to be left holding the bag. And that's what happened. That's why you saw the spike in the VIX go to 65. And then the very next day, you're back down 77% down to 15. So what you're looking at is people selling out of a fear. You're also seeing the algorithms feed on top of one another and trying to hit that next bid to get out. And then the rally comes in when you look at it from a macro perspective, people were calling for an emergency rate cut being announced here at Jackson Hole. Probably that's not going to happen. You were calling for 50 basis points, almost 60% the Fed fund futures were predicting during that hailstorm that we had. And now it's back to a 100% chance of a cut, 75% chance, if not more right now, of a quarter point. And we're going to see maybe 2 to 3 more cuts by the end of the year. So things are back to normal. And what's the reasoning behind it? People are looking at the economic data. It's actually coming into line, even with the revisions yesterday to the non-farm payrolls being a little bit more drastic than some people thought, but not unexpected. The market shrugged it off. We're down a little bit today because it's directional. It's a nice pullback. You're within a lob wedge for the S&P of the all-time highs. Pulling back a little bit from there is natural. If you look at the relative strength index for the S&P right now, it's trading with a 50 handle. So,
so it's somewhat it's not suggesting that we're oversold.
Nope. It's not overbought. It's not a 70. Overbought. It's not a 30 like we saw back at the beginning of August, which is an oversold condition.
Yeah, but then, it was over 70 just a week before that. So this whipsaw action is what's making it challenging for traders. But let's talk about earnings season for a moment here, Alex. Earnings came in better than expected. Sales relatively in line. That latter piece of data where sales are somewhat coming back, to equilibrium and not necessarily beating expectations handedly. A little bit of concern. Does that suggest anything in terms of growth slowing at all?
Combined with the city economic surprise being kind of consistently negative for the better part of the last quarter, I would say it highlights that, hey, the picture might not be overly negative, but it's a little bit less rosy than expected. Now, sales are still growing. They're just
Right.
not beating. So I think it kind of highlights what the Fed's talked about, which is the risks have shifted from a very inflation-focused market to one that's a little bit more growth or labor market in their case focused. But I think those two go hand in hand. I think NVIDIA next week is about as close to a Super Bowl that you can have for this market on a single company's performance. Consistently, you'll see 10% plus weight intraday. The movement of the markets are generated from one name, and that one name's NVIDIA. You're talking about a name that's moving 2, 3, 4, 5% a day that has a multi-trillion-dollar market cap. It's really unprecedented, at least in my career, which dates back at least the last decade or so. So it's going to be really, really important to keep our eyes on NVIDIA next week.
Yeah, for sure, because its tentacles run so many different types of industries. As you know, we're looking at this AI transition. I think options market is indicating about a 6.5% move. And to your point, on a multi-trillion-dollar market cap stock, it's a lot of market cap value that could go either way. But Chris, you on the Markets Intelligence Desk, you're talking to Nasdaq listed issuers, our companies, every day with a concentration in the consumer sector. And some of the tidbits that you have provided me insight on I don't know. It feels as if the consumer performed a little bit more in line than I think management teams may have expected.
Right. So that soft landing narrative, look at the overarching picture, is really kind of in play right here. You've got better than expected retail sales, which was one of the strong drivers. You've had a number of large consumer companies, retailers, if you will, over the last couple of days, report better than expected numbers and stronger guidance. And a lot of companies that we've talked with, Jill, and then you and I have talked about over the last year, it all comes down to the guidance. Companies are beating, but they're not raising, they're cutting guidance, and they're getting hurt on those days. So a lot of the times you look at the consumer, and we're right in the middle of consumer earnings right now, it's the haves and the have-nots. So, who's doing really well? Certain staples, consumer staples are doing well. People who are trading down are doing well. The mega companies, Walmart and Target, are doing very well right now. They were rewarded, and the off-price company stores are doing well right now. We need to see what the dollar stores bring. But when you look at specific retailers, some of them are getting very much beaten up here because people are not spending because consumers are waiting for interest rate cuts because that is very favorable to them. Look at home improvement stores, look at furniture. They're kind of hurting right now. And, what the comments out of Home Depot and Lowe's kind of emphasizes what we were already thinking right there. So disinflation traction is definitely evidenced by the cooler PPI and CPI. That's moving out well. Jobless claims are actually at a lower level than expected, which is pretty good. So people are working, but the non-farm payroll revisions were taken in stride. So at the end of the day, the consumers are slowing down, but they're slowing down for the right reasons, and they're purchasing what they need. And they're going to wait for lower interest rates, I think, until they start to make larger purchases. And I think once that starts to happen, and again, that'll take 6 months plus to kind of work its way into the system, that'll start to benefit some of the other companies as well. But definitely the trade down effect has hurt a number of corporations.
Yeah, it's interesting to talk about the discounters. I can remember the last time that TJ Maxx, as an example, a darling of the discounters, has not performed well across a number of quarters. I just can't.
52-week high yesterday.
Right. I just can't recall that. I mean, Costco, you can make the same argument. Walmart and Target, those were nice surprises. You're just starting to see it's not as much high end, low end, but I don't want to say middle of the road, but those specific areas that are just performing really well. And Alex, to wrap it up here with you, is there anything that stood out to you during earnings season, whether it's the consumer or other sectors where you can discern a trend?
Well, first off, I echo almost entirely what Chris said, but one thing that did stick out to me, and one of the key question marks, and I think Goldman actually raised this, which is, hey, there's all this money being spent on AI, but where are the potential returns? What are the use cases that's going to keep this spending going? I think Walmart did a lot in their report to kind of emphasize that there is some early stage use cases and returns that are meaningful. They talked about the efficiencies that had helped them with sort of cataloging and organizing all the products that they sell. That's going to send shockwaves, and I think it has post their report where some of that excitement back in the AI trade is there. Look, all sorts of boom and bust, new technologies, things go through bubble phases and kind of post-market adjustments, but the longer the excitement can kind of build up, maybe we bridge that gap where the kind of repricing, if there is one, can happen in time. as opposed to just simply a price comes down because some of this technology has maybe been priced for very lofty expectations, let's say.
All right. Appreciate both of your insights. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.